What if I told you that over $84 trillion is already in motion right now, and most people have no idea it's happening? Here's a fact that sounds almost unreal. Economists estimate that over the next 20 years, baby boomers will pass down more than $84 trillion in assets to younger generations. That number is so large it is difficult to even visualize. It is more than the GDP of most countries combined, moving quietly through inheritance systems, property transfers, investment accounts, and family businesses. But here's the real question nobody is asking loudly enough. What happens when the largest transfer of wealth in human history collides with the most complex financial system in human history? Because this is not just money changing hands. This is the structure of global wealth itself beginning to shift. And the strange part is, most people will never see it happen directly. They will only feel the consequences afterward. Let's start with the foundation of this entire shift. For decades, wealth was built in a relatively predictable way. You work, you invest, you buy property, you save, and over time, assets grow. Baby boomers benefited from a very specific economic environment: rising real estate values, strong job markets in certain regions, expanding financial systems, and relatively stable long-term investment growth. But that system is now doing something very different. It is unwinding through time, because wealth does not disappear when generations age. It moves. Slowly at first, through estate planning, inheritance, and gradual transfers. But once that movement accelerates, it creates ripple effects that can reshape entire markets. And here is where the first hidden issue appears. Most of this $84 trillion is not liquid cash. It is locked inside homes, retirement accounts, pension structures, investment portfolios, and private businesses. That means it cannot simply be transferred like a bank payment. It must pass through legal systems, tax systems, and financial institutions that were not designed for this kind of scale. So ask yourself this. If trillions of dollars are trying to move through systems built for stability, what happens when pressure increases faster than those systems can adapt? Now let's go deeper into real estate, because this is where a massive portion of wealth actually sits. Homes are the single largest store of household wealth in many countries. But here is what makes real estate unique. It is emotional, not just financial. People do not treat inherited homes like stocks. They treat them like memories, responsibilities, or burdens. And that creates tension, because when younger generations inherit property, they face immediate decisions. Keep it, rent it, sell it, or manage it. Each choice has tax consequences, maintenance costs, and market exposure. Now imagine that happening at scale across millions of households. At the same time, that is where market behavior starts to shift in ways that are hard to predict. In some regions, we could see sudden increases in property listings as heirs choose liquidity over ownership. In other areas, we might see long-term holding patterns that reduce supply and increase rental pressure. But here is the hidden question inside all of this. What happens when entire neighborhoods are no longer owned by the people who originally built or lived in them? That question leads directly into the next layer of this story. Investments. A huge portion of inherited wealth sits in stock, markets, and retirement accounts. But the behavior of money changes when it changes hands. Younger generations tend to invest differently. More exposure to technology, more interest in growth sectors, and more comfort with volatility. That shift sounds small, but across trillions of dollars, it becomes extremely powerful because markets are not just driven by companies. They are driven by behavior. So if even a fraction of this wealth begins moving toward new sectors, it could reshape entire industries over time. Technology, artificial intelligence, renewable energy, and digital platforms could see increased while more traditional sectors could experience slower capital rotation. But there is another layer to this transformation that is far more unpredictable. Digital assets. Crypto introduces a completely new problem into inheritance systems. Unlike traditional bank accounts, crypto assets depend on excess keys. If those keys are lost, there is no customer service line to recover them. There is no central authority that can reverse the loss, and that creates a silent risk inside the wealth transfer. Estimates already suggest that a significant amount of cryptocurrency is permanently inaccessible due to lost passwords, forgotten wallets, or poor estate planning. Now scale that across decades, as more digital assets enter inheritance systems, and the risk becomes much larger. So here is the question nobody can fully answer yet. What happens when traditional inheritance law meets decentralized ownership? We are already beginning to see the friction between these two systems. Now let's shift to something less visible but just as important. Institutions, banks, hedge funds, insurance companies, and wealth management firms are not passive observers in this process. They are actively preparing for it. Why? Because they understand something very simple but powerful. Wealth does not just transfer between people. It transfers through systems. And whoever designs or controls those systems often captures long-term value. That is why entire industries are now focused on estate planning, intergenerational wealth management, and advisory services for heirs. This is not random. It is strategic positioning. But there is a hidden consequence here. Not all wealth survives transfer equally. Businesses, for example, are often the most fragile part of this system. Many family-owned companies do not successfully transition to the next generation. Sometimes heirs do not want to run them. Sometimes the business depends heavily on the original founder. Sometimes tax obligations force liquidation. And when that happens, wealth does not always stay within families. It often gets absorbed by larger corporations or institutional investors. Which leads to a deeper question. Is this truly a transfer of wealth, or a quiet consolidation of wealth? Because depending on how these transitions unfold, the outcome could look very different from what the headline suggests. Now let's talk about psychology. Because numbers alone do not explain everything. Behavioral finance shows that people treat inherited money differently than earned money. There is often less emotional attachment, which can lead to higher risk-taking, faster spending, or more aggressive investing. Now combine that with a generation that is more digitally connected than any before it, exposed to global markets in real time, and influenced by fast-moving financial trends. That creates a completely new financial environment, one where decisions are made faster, markets react more quickly, and wealth can shift between asset classes at unprecedented speed. But here is where things become even more complex. Because while individuals are adapting, institutions are also adapting, but not at the same pace. And that gap between individual behavior and institutional strategy is where some of the biggest financial opportunities and risks will emerge. Now step back for a moment and look at the entire picture. Real estate is shifting, investments are rotating, crypto is introducing new risks, institutions are positioning aggressively, businesses are being restructured, and behavioral patterns are changing across entire generations. Individually, none of these changes seem like a system-wide transformation, but together, they form exactly that. A global restructuring of wealth flow. And here is the most important thing to understand. This process is not a single event. It is gradual. It unfolds over years, even decades, which means most people will not recognize it as it happens. They will only notice it when outcomes become obvious. Higher housing prices in some areas, sudden liquidity in others, changing investment trends, new financial winners emerging faster than expected, and traditional systems slowly losing dominance. So the final question is not whether this will happen, that already is happening. The real question is whether you will recognize the shift while there is still time to position yourself within it. Because once these trillion-dollar flows stabilize into new patterns, the biggest advantages will already be locked in. And that is why understanding this moment matters more than trying to predict every outcome. If you found value in this investigation, like this video, subscribe, and comment below what you think will change the most over the next 20 years. Real estate, investing, or digital assets.